Damn. Well, going back to the macro stuff,
Yep.
When you talked about double-digit down on bonds and equities, do you see a recovery or is this just a death spiral?
A recovery in bond prices? Okay, so absolutely. I mean, look, bonds have now gone from a 1.5% US 10-year to close to 4%. It topped out at higher than 4%.
By the way, is that actually a good thing?
Yes.
Yes.
And they're still not high enough.
Right.
Because you still have nominal yields after you subtract out your CPI,
You have your real
negative,
yields,
negative
Right.
real rates. That being said, there's an element, and I said this on stage here in the conference, that people are going to change from being worried about inflation to being worried about credit risk of the USA. And that's what an interest rate is. It incorporates an inflation expectation and a concern about credit risk. And up until now, nobody in the world has worried about the potential default of the USA. But guess what? And I saw the chart you had there, the graph of the Congressional Budget Office that showed the deficit in the USA, that graph right there.
Keep it up, Danny.
It is a beautiful, if this was a company, you wouldn't touch this thing, okay?
Right.
This is so ugly.
Foss,
you look at this. Yep.
Explain this to people listening on the phone.
So the primary deficit, okay? The total deficit is the combination of the purple and the blue. But the primary deficit is your fixed costs. It's your military spending and it's your entitlements.
Yep. Well, and others,
Okay.
right? So those are the ones you just listed are mandatories. They're under legislation, but
This is the government budget.
This is the government, and it's
Right.
done
Basically.
by the Congressional Budget Office.
which means that it's quite optimistic.
Doesn't matter. It's still so pathetic.
Which is pathetic.
Is that you are going to have a total deficit in 2051. Okay, it's how much on an annual basis you are losing.
Is this accumulating every year? Or is
Well,
this a
don't
separate?
forget, when you don't pay off last year's,
Yeah.
you have to pay interest on it, and it gets bigger.
Is it gonna
it's deficit as a percentage of GDP for the USA? You're getting a deficit that's 15% of the GDP of the USA annually. And the biggest component is your net interest, which is because the interest coupon has to roll over and fund the deficit from the prior year. So it's organically growing because of the debt spiral.
So let's talk about that for a second. So this is a great chart because it shows that the CBO, the Congressional Budget Office, admits the problem.
Yeah.
But let's talk through the real problem, right? So going back to what Greg was saying, so you've got your GDP, right? We're
Hold
already
on, just one second, James. I just want to explain to the people listening just what we're looking at, and we'll put it in the show notes. But essentially, what we're seeing is the deficit year by year. We have an anomaly in 2020 and 21 because of COVID, I imagine.
Correct, that's
So there's a
exactly what it
massive
was.
amount of borrowing.
Yeah.
And then what we see is going to drop back in 2022 to about 5%.
Correct.
Okay, and then
Of GDP. Now
of
let's
GDP.
be yeah.
Okay, and then from 2027, it's going to be about the same, but it's going to go up to about 15% by 2051. But the majority of the increase is interest.
It's ridiculous.
Correct.
All right, so
Yeah.
let's just walk through how it's ridiculous. Right now, first of all, our baseline deficit right now is $1 trillion.
Yes.
Okay. All right. So let's walk through the numbers really quickly for your listeners to understand what Greg is talking about. And we talked about this, and that's why I wrote that newsletter about the debt spiral in the United States. Right.
Yes.
So. Okay, so tax revenue is your major source of income for the United States, okay? And that's driven off of your GDP, your gross domestic product, right? So, and that right now is running at about $4.5 trillion. All right, so you've got your major expenditures are your entitlements. Okay, these are signed into legislation. These are mandatory expenses, right? Which is about
Social Security?
Social
Social
Security,
Security,
Medicare,
Medicaid, yeah.
right? And that's $3.7 trillion. Then
Hold on, what's GDP of?
GDP of the USA about 24 trillion.
And tax revenues are about
4 trillion.
4 trillion. It's $3.7 trillion is mandatory. Then out of your variable expenses that change year to year, you've got military, okay, which is $800 billion. But those are contracts. So you kind of count it as a mandatory because they're invoices that they're getting from these contractors that they've agreed to, make these defense products for them, right? Or defense systems. So then so that's 800, right? Then your current interest on your debt is at $400 billion. Okay. So the number is actually $4.8 trillion of revenue. Okay. You've got 3.7 trillion in entitlements, $800 in defense. Now you're at 4.5. Then you've got $300 billion left over for interest expense. However, today your interest expense is at $400 billion. So you're already running an additional deficit of $100 billion, okay? Now, Larry Lepard and I sat down before this conference and talked through a pro forma of next year. So, okay, remember, your total, if you include everything, so forget about the mandatory only, if you include everything, we're running at, right now at about $1 trillion of deficit, right? But now next year, if you peel out from our revenues the $600 billion that we got, which was kind of a one-time deal in 2020 after all of the money printing and the stock market and all the assets went up. They had a great capital gains revenue line item of about $600 billion of additional, right? So pull that out. And then also we have right now about $400 billion of additional spending that the government the Treasury has said that they're going to have to issue bonds at going into the fourth quarter, into the first quarter, okay? So now you've got the 600 plus that 400, plus another $150 billion, the COLA, the cost of living adjustment on those entitlements, right? So you're about at another $1.2 trillion. Add that to the $1 trillion deficit you're already at. That's $2.2 trillion, okay? Now hold that, right? But then when you add in that we're going into a recession, and the last two great recessions we were in, which was a tech bubble in 2000 and 2008 was the great financial crisis, your tax revenues dropped between 8 and 10%, and your entitlement spending went up between 8 and 10%. So now that's all another $800 billion to $1 trillion, okay? On top of that $2.2 trillion, if we go into this downward, economic spiral, or at least into a hard recession. So now you're at over $3 trillion. Now look at the chart and see how rosy that picture is from the CBO. Even though, okay, so if you look at 2026, it's showing what? 5% as a percentage of GDP. Remember, GDP is $24 trillion.
So 5% is $1 trillion.
And that's going down.
Okay, so this is bullshit.
Well, but it's still so ugly.
It's still so ugly.
If this was a company, you would never touch this.
This is what the U.S. government is doing, okay? If they're assuming, yes, exactly what you just said, but instead of cutting spending or getting a second job, they can't get a second job. Where are they going to drive revenue from? Instead of what they're doing is they're operating on credit. So they've got a credit card that they're overspent on, and they've got an interest rate on it. So now their mandatory expenses of your mortgage and your car payment and food, right? So you've got all those things you've got to pay for you and your kids. Well, you're not meeting that margin with your job, with your revenue. So you're not cutting out food, your mortgage, or your house. So what are you going to do? You're going to take out another credit card. And then you're going to pay the interest on that credit card. And then eventually you're paying so much in interest that you have to take another credit card.
There's your blue line.
And that's the blue line.
That's your net interest. And that's so it's the equivalent of being in credit card hell. Okay?
It's a debt spiral.
You are taking out more credit cards to pay the interest on your old credit cards.
And this is why there will be a default at some point.
Or
this gets to what
they print a load of more.
Thank you very much. The fiat currency is the error term which balances this debt spiral.
So they print out, pays back in normal terms, loses
to oblivion.
As long as it continues going.
Does that affect credit rating though?
Okay, absolutely it does. But that's why the credit rating companies are conflicted. If this was a corporation, there is no question it would be rated CCC. Okay? It's a very simple calculation on EBITDA interest coverage. And the USA does not even cover its interest expense by one turn. James ran through the math, which meant that as a company, those are defined as zombie companies. Well, guess what? The USA is a zombie country, and it's the best country in the world from a financial perspective.
Yeah. There were times where we would run a surplus, and there were times where we would run a deficit. And it just feels like we never have a surplus anymore.
Okay, why? Because your organic growth in your debt is at a point where the growth in your interest is outstripping the possible growth of your economy.
But why is it happening now and not? And I've got a couple of theories. I think one is globalization. I think
no, Paul Volcker was able to do what he did because total debt to GDP in the USA at the end of 1988 was 30%. And now total debt to GDP in the USA is 130%.
But why have we got there
so
now?
think about it. So just think about it. If your interest rates are going up,
Yeah.
right, and you're running a deficit, well, now your interest payments they're getting bigger. So each year that your deficit is growing. And
Just
so
by the
that's the
organic
problem. It's just
growth.
math, right? So think about it. So now you've got $31 trillion of debt in the United States right now. Right? So if your interest rate, which is why the Treasury is like, they're on guard here.
Yeah.
So you got $31 trillion up there on the left, right?
Yeah.
What did we come up with?
It was
About
1.5%. They're funding themselves at 1.5%.
Yeah.
Make the math
Yeah.
easy. On
Yeah.
31
Yeah.
trillion, they have $450 billion annually of debt, which James pointed out. 38% of that debt rolls over in the next 2 years and will be funded at a 4% coupon because that's the open market rate on debt now.
Okay.
So there is the growth in your interest expense.
Right.
You go from a 450 billion to meaningfully higher because the debt rolls at a much higher coupon.
Hold on, question.
Yes.
I think I've just realized something that I hadn't fully realized before. When you just said the debt rolls over,
Yeah.
because they have to pay off the old bonds, they have to issue. They have to issue the new ones to roll over.
Yeah.
Exactly.
Right. Okay.
4.5.
Here's how crazy it is. Everyone focuses on the U.S. national debt in the top left corner.
I'm looking at US total debt.
Where do you see that one?
93. Oh, fuck.
No, go down to the bottom
All the way
line.
down.
Holy
US
shit.
unfunded liabilities, 170 trillion.
Hold on. We nearly need
So
a
add
new.
that to the 31.
What comes after trillions? Is it quadrillion?
It is. But let's not even go there because that's $200 trillion. You take your unfunded here, 172 plus 30, you're at $200 trillion of total obligations by the U.S.
Hold on. Okay. So say $200 trillion. What are those unfunded liabilities?
Medicare and Medicaid. It's right there. You see them right there. Medicare liability, Social Security liability.
But over what period?
It's on their books now. It's the promises to the citizens going forward.
Yeah, but like,
30 years?
okay, 30 years.
Yeah.
Okay. Shit.
No, but this is math.
This is and
This is the math.
and this is why you need inflation to.
It's over.
But go down to the lower right. See what the liability per citizen is?
Fucking insane.
It's not funny though. These are our kids, Peter.
No. But,
Yeah.
but it's so fucking stupid.
It
It's
is
funny.
exactly that.
It's
Now,
like
you said, how
insane.
did we get here?
Yeah.
Any 4-year president that's going to try and fix this will not be in office for another term. So he is not incented to fix this. It's besides it being mathematically impossible to fix.
Unless they elect a guy who probably won't be alive by the end of it, and then maybe he can have a go.
We've had enough people that shouldn't be in office at that age anyway. But
go back up just a couple of lines. You see the U.S. millionaires down there? You see the number of millionaires?
22 million.
There's 22 million millionaires. How many Bitcoin are there going to be ever printed?
21. This is a great chart, and they do this by country, right? You can look at this same thing for Canada. Let's not do it.
They will not
22
all
and a
be able
half.
to get one.
22.
It's
We're
not-
actually around
mathematically not possible.
23 millionaires.
Yeah. Just here in the United States.
Yeah, that's ridiculous. Hold on, that's
There's
more than
50
5%.
something. Yeah, 50 something in the world. Yeah.
Jesus.
Yeah.
This stuff is insane.
It's math. This is why it's so simple to see this. And then we could get into the credit default swap market. And you could see how Bitcoin, even just on the United States, should be valued at somewhere close to $200,000 just because of the insurance on the USA. And then you get all the other countries for free.
What does it used to say? Bitcoin is a credit default swap on. Used to say something.
On a basket of fiat currencies.
Yeah.
But you could just do it as a credit default swap on the USA and see how cheap Bitcoin is.
Oh my God.
But you see, here's the cool thing,
okay.
Peter.
Yeah.
We've been involved, you and I, talking about this, and I love the aha moment. You just had your aha moment.
Yeah.
Well, no, there's certain concepts you just suddenly get.
That's
you know.
fine. But you have to keep
Yeah.
repeating it because
Yeah.
most people don't.
Sorry.
Go ahead.
One that stands out to me: savings per family, $9,500.
9,500 versus the liability per citizen. 500. So what's the average family in the USA? 4. So the average family has $2 million of liability, and the savings for family, a whole $9,500.
I'd love to see a UK version of this.
There is a UK
It's
version.
there.
There is?
Yeah.
Oh my God, let's have a look.
You get your public debt to GDP 104% versus USA. Well, that's the public debt, but you got to take your
Well, the
total
UK
funding.
just jumped over 100% this year.
Yeah. But these are cool. I mean, but it's not a good scenario. And the best scenario is the USA.
Oh, look at Italy. Italy's fucked.
No, well, that's why we always said it.
Oh, God, yeah.
But let's not spend too much time on it. It's that simple. You need insurance against this.
There's no way back.
Mathematically, no.
No way
So
back.
what do you think they do, Greg?
So what do
you think they do?
The countries?
Yeah.
We go into something called financial repression, and James will expand on this, where you try and run inflation hot, and then you use a component called yield curve control, which keeps your interest rates low. And you hope that your GDP grows into your debt burden.
Right.
Because of the natural inflation to your tax base, which follows inflation, but bonds get skewered and the printing of money is so crazy, it's QE infinity, and hard assets go parabolic.
So just remember that your nominal, you're getting this bump in GDP from inflation, and nominally you're paying back these. So what Greg is saying is that you're paying back this debt with future dollars that are worth less, right? So if I give you $100 today and loan it to you, you can buy 20 Starbucks, right? So in 10 years, how many Starbucks do you think you're going to be able to buy with that $100?
Maybe 5.
Right. So that's exactly what they're doing with the debt. It's the same thing.
Yeah, well, this is a conversation I had the other day. You know, we run a successful business here, and I don't know what the fuck to do with the money. We've put money by as a runway for the business, but also at the same time, I'm going to lose 15% of that next year by not spending it.
You're totally right.
What the fuck do you do? You can't put.
That's why it's evil. It's ridiculous.
Yeah, it is. It is fucking evil, and it is ridiculous, and it's insane. And
Maddening. Yeah.
Yeah, maddening.
Okay, yeah,
It's maddening.
I have
and
three
you
kids.
try to be, portfolio managers. That's why everybody's reaching for yield to try to, they're trying to keep ahead of all this printing.
How long do you think they can last before they have to start dropping rates again?
Well, I said that 4.5% would be where things really start breaking. We're starting to see things break already. LDI in the UK was absolutely something that broke.
Yeah.
Okay, so we're seeing things break. And the best economists that I follow, macroeconomists like Luke Roman, feels the same way. There's a sustainable amount of interest expense that the USA can endure, and we're at that level right now. And just look at things that are breaking around the world.
but to sustain that acceptable amount,
You can't sustain it at this rate.
What I'm saying, if they can find an acceptable rate, they can maintain that. That is going to lead to a gradual and insidious erosion of living standards
100%.
for everyone.
Right, because what they'll do is they'll jack up the rates as quick as they can here, which is what they're doing, and try to get that inflation down to a point, right? Declare victory, probably somewhere around 4 or 5% inflation, which is the number that they're sharing with you. But we all know that the real inflation rate's higher. And then back those rates off so they don't have to pay higher rates for the treasuries that they issue.
Is there a sensible option that no one's putting on the table because it's politically unpopular? Is there like something you guys go, wow, if they did this, or is it literally?
They had a chance to do it after the great financial crisis, and every time they tried to do it, there was a taper tantrum. So now there is a point. There is no return.
No debt jubilee?
Yeah, they kept. I wrote a piece on that. No, I mean it doesn't physically work. You leave a hole in a balance sheet, in the Fed balance sheet.
What do you think that would do to pensions?
So.
Then it's
Look, there's one option. All paths lead to Bitcoin. It's that simple.
Yeah, and it's going to be a messy, strange transition that won't be pretty.
It could be. Like people, I mean, look at how long it's been going on with Japan. We don't know how long it takes,
Well, careful. Japan is a nation of savers versus.
So Japan is a nation of savers, and they're a net exporter. We're a net importer. Okay, so it's a different dynamic. Absolutely. However, also a different dynamic. We've got the reserve asset of the world, which is U.S. Treasuries, and everybody needs dollars, and everybody uses Treasuries. So that's our advantage, the United States advantage, right? So the one that'll break first is Europe. That'll break before Japan.
But was it Jeff Snyder who said that it won't break because the U.S. will actually have to rescue Europe?
Okay, I mean,
he talks about
I agree with Jeff on certain subjects, and I also don't agree with him on some. But that's what makes a market. All right. Look,
when Europe breaks, is it the euro that breaks, and will the pound be independent of that?
Well, it depends. It depends on what actually the function of it breaking is. I believe that eventually Germany just gets fed up with all of the debt that the ECB is allowing these other countries down in the south, the Italy, Greece, Spain, Portugal, to take on at the expense of Germany, and there's no function to pay it back. I wrote about it in Target 2, the interchange. And so they're owed over $1 trillion. And some of that is from the ECB itself.
And
there's no function to pay it back. So at some point, Germany will just say, you know what, we're done with the euro. Maybe we're done with Europe. It's going to be...
If that happened, and say it happened the other way first, say Italy voted for its own Brexit and went back.
How would it? What would it do?
I don't know. I'm just saying, just any country. Just say one did.
If Italy wanted to leave the European Union and not have the ability to use Germany's balance sheet,
is there a way
those banks would fail?
Let's not overthink things. Okay, the USA will be the last country to fail. Canada will fail, in my opinion, 10 to 20 years before the USA does, and Canada hasn't failed yet. So let's assume that this can continue. I think to answer Danny's question, how long can it go? Probably at least another decade. Why? This is the Ponzi. It's the FTX. As long as you don't let people see what the true mark should be, we can continue to pretend this Ponzi will continue to go.
Yeah,
and perpetuating the Ponzi, is that oppressing smaller developing nations?
Crowding out of capital. Of course it is. It's crowding out the capital that, there's a limited amount of capital in the world. And as the USA becomes a greater and greater borrower, it crowds out the ability of capital to flow to lesser fortunate nations.
And the stronger US dollar just it exports our inflation, right? It makes it more expensive for people to buy, US goods. And so
does any of this make you suspicious of what's happened in Russia and Ukraine, that was Russia recognizing this?
Oh my God. Absolutely. He doesn't want US dollars for his valuable natural resource energy. He basically called it out to his Politburo.
Exactly. He said it.
You take the translations. It doesn't get much MSN coverage, but you look at the statements translated. He basically says, why would I want to own a fiat currency,
paper-based currency,
that they can restrict me from using when I need it?
Yeah.
It was brilliant. Putin's a Bitcoiner. I'm not supporting his military or his anything like that, but he understands the difference between soft money and hard money.
Do you think that's a bit of a peek behind the veil for people like China as well, who won't want those treasuries?
Not necessarily China, but how about we extend it to, what's happened with the Saudi Arabia kingdom and disagreements with President Biden is the same thing. They don't want their valuable oil resources being paid for in US dollars. Now, there is that agreement because they need to have protection from their enemies from the US military.
Right.
So it's difficult. But it all comes down to energy. It all comes down to natural resource energy for digital energy, hence Bitcoin. Yeah. Pretty simple.
Super simple.
I need a whiskey, man.
That being said, all paths lead to Bitcoin. The longer that we can develop a parallel network, the better. And that's what we're doing right now.
That's right.
We're developing this rescue network. Be positive, not negative. Because, drink whiskey, because the reality is it's not a pretty situation.
There would be a US dollar and US Treasury kind of parallel system until Bitcoin just takes over.
And it will replace the US Treasury system as global reserve asset. Yeah. And the US dollar can maintain global currency status.
Have you independently come to that conclusion, or was this part of the conversation?
No, independently. That's why I loved it.
It's going to replace the bond system, did you say?
It will replace the U.S. Treasuries as global reserve asset, not global reserve currency. And this is why...
What's the trigger? What's the trigger?
The trigger is Jason Lowry convincing his superiors that the survival of the U.S. dollar could rely on Bitcoin. That simple.
I've got some Canadian bourbon here. So.
Let's call it a great day of talking.
Oh, man, that was amazing. Thank you so much. Foss, love you, man. James, great to meet you.
Awesome.